Did you know that 71% of property investors only have one investment property? 71%. It makes me think, do a lot of people get burnt with the wrong type of investment properties and then they freak out and they decide not to go on to buy more? Well, this is something that I've been thinking about for a while, and I wanted to unpack with you some of the reasons why if you buy a dud property, you could be stuck being in this 71%. Whereas if you buy the right property, you can move up the ranks and start to acquire more properties and build out a portfolio. In today's episode, I'm going to unpack for you what I see is a dud property, what you should definitely look for and what you should avoid when choosing a property, and how can you make sure that you're going to buy a property that's going to perform and align with your goals. So stick around, because this episode could potentially save you lots of money, or it also could potentially make you lots of money. On this podcast, we talk all things rentvesting, property, and getting ahead. And if you don't know me already, my name is Steve Williams and I'm the founder of W Property Advisory, and we've helped people across the country get their foot into the property market and start to get ahead with property. I'm a passionate property investor. I've been investing for over 16 years myself, and I love helping people on the journey. So if you're wanting to learn about property investing, I'd love for you to subscribe to the channel. Hit that subscribe button now, and we'd love to see you in future episodes as well. All right, so what actually makes a dud property? And I'm going to preface this because I think a dud property is seen as a dud from different angles. Some people might see a property as a great opportunity. Some may see it as a dud. And what we need to do is wind back and realize that when we're buying property, it needs to align with what our individual goals are. For some people, they might be more aggressive. They might be wanting to chase growth right now, which means they need to buy in a growth location. For other people, maybe they're buying for a lifestyle, maybe they're buying for more of a longer term play, or maybe they're trying to chase cash flow, or maybe even they're going to do a development or do something to the property that's going to add value. So it's really important that we firstly understand what's the reason why we're buying this property and how does it align with our portfolio and our long-term goals. Once we've got this awareness, now let's look at what would actually make a dud property. Is it the fact that it doesn't grow in value? Is it because the maintenance costs are massive and you have to fork out tons of money? Is it just the perception that it's an old property, so it must be a dud, right? Or have you bought into a complex where you're getting very low rental yields or very low returns and having to pay astronomical strata fees? These are some of the things that we want to consider when deciding if it is a dud property or not. Maybe you're looking to buy a property and you're thinking, hey, I don't want to be burnt. Is this property going to do what I want it to do? Or maybe you already own the property and you're thinking, I think I got a dud on my hands, and what should I do with it? And stick around to the end, because we're going to talk about what we're going to do if it is a dud property. Should we shift it off or should we keep it and play it out for the long haul? Now, let's unpack it. All right, so dud property, number one, is a property that doesn't grow in value. Now, it depends on how long you're planning to hold the property. If you're planning to hold it for 10, 20, 30 years time, over the long term, most locations across the country are generally going to keep up to pace with each other. Yes, some are going to perform better than others, but if you're looking at a long-term play, you're likely to get a fairly okay result if you buy well. Now, we're talking about houses here. Apartments can perform quite differently. I've had apartments before in the past. I had one in Melbourne that did nothing for 12 years, and therefore I offloaded it because it just really wasn't suiting my portfolio, and it kept me stuck from going on and building my portfolio out from there. But if we're talking about houses, generally over a long term, houses are going to do pretty well, right? The average standard is around 6.8% growth over a 30-year period. Of course, some locations do better than others, but if we can, work out, are we looking to buy for the long term or the short term? Now, if we're looking to buy the short term, if you have an aggressive goal to build a portfolio in the next 3 to 5 years, well, having a property that's in a stagnant location is not going to suit its purpose for you. So in this case, I'd probably call that one a dud for now, and you might want to reconsider what you're going to do with it. So that is a dud property based on its growth prospects. The next type of dud property is about its rentability, right? So you've got this asset. Of course, you want to get tenants into it to help pay for the mortgage and the expenses, and of course, to provide a home for someone to live in and enjoy. If you're buying in a location where the vacancy rate is high, there's not many tenants around and not many applications, then firstly, the quality of tenants you're going to get and also the potential rent is going to be sacrificed here, because you want to be in a location where you can attract decent tenants who will pay a fair market rent for the property so you can sustain that property over the longer term. And then finally, another one is around maintenance costs, right? Now, Some properties, they have maintenance. They're physical assets. And I always tell my clients, always keep a little bit of a kitty aside because you want to maintain your asset to look after your tenants, look after your property, and make sure that it holds its value. Now, I've bought properties that are absolute shockers in the past. Like these things are absolute dives. I'm going to show you a photo of it. Like, check out this. This is like horrible, right? But it's actually performed really well. It's actually grown in value by about $200,000 in a period of about 2 years. So for me, even though it looks like junk, it is not a dud property because it's suited my needs, right? But if you're in a location where your growth is not good, maybe you're having a struggle getting tenants or getting decent rent for the property, and maybe you're forking out tons of money in maintenance, well, for me, that's probably more of a dud property. So to recap with that, a dud property is depending on what your goals are, whether you plan on to hold it for the short term or the long term, or whether, is it actually meeting your needs? Now, there's other sort of property investments which I would steer well clear of, and I'm going to cover this in another episode, but you want to be careful of getting sucked into some of the salesmen who sell you these junk assets. Like I had a guy call up recently who's being offered an apartment for $250,000. Sounds cheap, right? Get your foot into the market. You even get guaranteed rent of 6%. But what the downside was there was those huge strata fees, and it was actually part of a hotel chain, essentially. So it was almost like a timeshare situation. And I asked him, I said, look, go back and have a look at when did the last one sell? And he said it actually sold about 2 years ago. And I said, all right, well, what was the change in price? And he said, it's actually the same. I said, well, so you're going to buy an asset at 250,000, which in 2 years is probably going to be worth 250,000 again. You're paying, you're getting 6% income, but you're paying mortgage rates of 6.3%. And of course, your costs on top of that, that is a dud property because you're literally paying to hold a property for no benefit. And so that for me is a huge dud property. So you want to avoid ones like that. And often when you hear deals that are too good to be true, then they often are too good to be true. Another type of dud property is people talking about NDIS housing. Now, you want to be really careful with NDIS housing. Personally, I actually haven't I heard a good story about NDIS housing. I've heard a lot of people that they build it in locations where there's actually no demand for NDIS housing and people get stuck and they can't afford to pay the mortgage because they've got no tenants or not enough tenants to actually fill the property. And therefore, they're actually making big losses on this, despite the fact that there are some builders that unfortunately are not doing well by their clients, and therefore they're massive build costs, and the properties don't retain their value because often the build cost is well ahead of what a standard house would cost to build in these areas. So there are some reputable builders out there and some providers that are doing really great stuff, and it's a really great scheme providing houses for people who really are in need. But always do your due diligence and choose a reputable company and really find out if there's case studies that you can verify to work out if it's actually going to deliver what you're being guaranteed or promised. Another type of dud property in my eyes is apartments in high-rise towers where there is a ton of supply. Often they're sold off the plan and they look really great and shiny in the brochures. And, it does mean that when they come up for lease, there's a lot of apartments for lease in that tower. And if you're in a location where there's low demand for rentals, you might find that you're stuck with a dud asset. You might not be able to get the rents that you're after. And also the sales price. Often sales prices can actually be lower after it's constructed than what you paid for it off the plan. However, on the flip side, sometimes they can do really, really well. And it's all about supply and demand. If there's an excess of demand and low supply, then great. But if you're buying it in a location where you can see there's tons of towers being built everywhere, then I suggest you just aim to be on the side of caution. I've talked about what I see as a dud property in my eyes. I'd love to hear your stories if you've bought a dud property or you know someone that's bought a dud property, and maybe you're one of those people that's been stuck in that 71% of people that only have one investment property. Well, what I want to do now is I want to unpack some of the key things you want to keep an eye out on if you are looking to buy a property. Now, as I've said previously, property is all a case of supply and demand. When there's excess demand and low supply, then essentially it means that prices go up. So essentially, you want to buy in a location where there's high demand and low supply. It's as easy as that. And there's ways that we can measure this through data. Demand, you can see how many people are looking to buy in an area. We can see how fast properties are selling. Are they starting to sell faster, or are they actually starting to take longer to actually sell. That is a good indicator of the demand in an area. Then we've got supply. How many properties are coming up for sale? Is that increasing? Is it decreasing? And also, what are the building approval levels like? Are we seeing more houses being constructed in the area? If we can look at those basic supply and demand metrics, it's going to give us a good idea of what likely the growth is going to be in that area. Now, there's other drivers as well. We've got things like population growth, and population growth has been massive in Australia over the last couple of years with international migration, and some places have done better than others. WA's been a big standout, 2.8% population growth. Melbourne is at 2.1%. They're doing quite well down there as well with population growth. So as people move around the country, this is going to create demand. Like as we saw during COVID, a lot of people from Sydney and Melbourne moved up north to chase the sunshine, and this created a lot of demand up in the southeast Queensland and northern New South Wales region, which then meant the prices went up because there was a ton of demand and there was really no increase in supply. So population can have a big impact on house prices. Another reason why properties don't perform is because people buy with emotion. They're not actually buying with logic. And I recently spoke with a friend, and he was talking about how he's wanting to buy a property in a coastal town not far from the city in which he lives in. And this place is beautiful, right? It's by the beach. It's got a nice country town feel. And yeah, it's got lots of nice little local amenities. And it might sound well and good, but the data just didn't tell the right story, right? It's got the lifestyle ideals, but the days on market, we're talking like 50 days to sell a house. There was land that had been sitting there vacant forever, and there just wasn't many buyers around. So while it might mean he gets a good price now, but if he's wanting to chase growth in the short term, it's probably not going to be the case. It might even soften or go down. Whereas if he's looking at a longer term situation, then yeah, that's a different story. We also want to buy properties, of course, based on the location if we're looking to chase growth, right? It doesn't really matter what the property looks like or how dodgy it is. As I said, I had one of the dodgiest houses in Perth, and that property grew in value by $200,000, and I have hardly spent any money on it. But at some point, that's going to flatten out, and of course, there's going to be maintenance costs, so it's not going to perform as well. So these are really some of the things that I consider that you want to look out for if you want to choose the right property. We really want to look for what's the demand and supply, what's going on with the population, what's going on with the economy as well. Is there jobs? Is there people wanting to live there? And what's the lifestyle like? We definitely want to avoid making decisions based on our emotion, because if we do that, we're going to probably make the wrong decision. All right, Steve, so I've got myself a dud property. What should I do? Well, I feel for you because I've had a dud property. When I was 23, I bought an apartment that did atrocious for 12 years. I was forking out tons of money in interest and also in strata fees. And there was also a levy for windows of 14 grand. And I just kept holding on because my ego said, nope, it's going to grow. But I had to make a call. I looked at the data. I got some advice from local experts of that area. And for me to actually go on and progress my portfolio, I needed to make a tough decision. So if you've got a property like this, what you want to do is go through some of the things that I talked about already. Look at the demand in the area, look at the supply in the area, look at what your maintenance costs, and do a bit of a calculation to work out how is this property performing for me? And even though you might have maintenance costs that you are forking out, maybe you've had to spend $3,000 on a new water heater and maybe put some new gutters in the property for say $4,000. And it might seem like it's a dud property, but if that property is actually growing at a rate that's exceeding your income and also the expenses you have for that property, well, it's probably not a dud. So you really need to work out, okay, supply and demand, what sort of maintenance am I spending on it? What does the cash flow situation look like? What are my longer term goals? How does this align with that? If it's keeping you stuck from building your portfolio, then it might be time to sell. So I suggest putting it into a Google Sheet or Excel and working out, putting these figures down and doing a bit of a cost benefit analysis and deciding whether it's right to do it. Now, of course, you're going to have some expenses come up. You're going to have capital gains tax, but also you're going to have stamp duty, right? So if you're going to go buy another property, you're going to have to pay stamp duty again, which might be anywhere from $15,000 to $40,000. And therefore, we need to factor that in because the cost of buying is going to be, costly. Of course, you've also got your selling costs. If you're going to use a sales agent, then you might need to fork out anywhere from $8,000 to $20,000 on a standard investment property with your marketing costs as well. So factor that all in and then make a decision. So in the decision I made, right? So I had this apartment, was doing nothing, and had to make a tough call. I knew I'd fork out agent expenses of $12,000. I had capital gains tax to pay, which was, I think was about $30,000. And then I had the stamp duty to buy a new property. Now I sold this property and it actually, coincidentally, in the next year, it actually went down in value. So I actually sold at the right time. I bought this property in Perth. This was that dodgy house that I was talking to you about. Bought it for $550,000, and that one is now worth about $750,000 just 2 years later. So I've made a $200,000 increase in benefit compared to the apartment that would have still been forking out money each week. So that was a good decision in hindsight to make. So my recommendation is put the numbers down, work out what is important for you and what your goals are. And the big thing is you need to make a decision, because if it's keeping you stuck and you can't move forward, then it could be costing you lots of money. Well, I hope today's episode has given you a good overview of dud properties, how you can certainly avoid a dud property, what is a dud property, and then if you got yourself a dud, what should you actually do about it. Again, if you've had a dud property before, or maybe you've heard of other stories of dud properties, place it into the comments. I love to hear from the audience, and please subscribe to the channel so we can see you at the next episode. It's always great having you here. Until next time, let's rentvest and get ahead together. All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs, and speak to a professional.